Urgent. Wall Street's biggest bank just made a move that changes everything. For months, JP Morgan has been bearish, warning clients, selling positions, preparing for the worst. But according to sources inside the firm, they've completely reversed course. And when the world's largest bank flips from short to long, you need to pay attention. Here's what we know. Internal documents leaked this week revealed JP Morgan has quietly started accumulating massive positions in sectors they've been publicly trashing. We're talking billions in capital being deployed while retail investors are still running scared. This is not just portfolio rebalancing. This is a strategic pivot that suggests they know something the rest of the market does not. The timing is suspicious. Right before major economic data drops. Right as sentiment hits rock bottom. Right when everyone else is selling. It's the classic Wall Street playbook. Scare the crowd out, then buy what they're dumping at a discount. But here's the kicker. They're not just going long on stocks. The leaked intel shows they're positioning across currencies, commodities, and specific emerging market plays that most analysts aren't even watching yet. This could be the trade of the year, or it could be a trap. In this video, I'm breaking down exactly what JP Morgan is buying, why they flipped, and most importantly, what you should do about it. If this information helps you, smash that like button. Let's get this critical intel to everyone who needs it. Script begins. So let us dive straight into what's actually happening here because the implications of this move are far more significant than most people realize. When we talk about JP Morgan flipping long, we're not just talking about a simple change in market sentiment or a minor adjustment to their portfolio. We're talking about one of the most powerful financial institutions in the world, completely reversing their strategic position after months of very public bearishness. And if you understand anything about how Wall Street operates, you know that when the big players make moves like this, they're doing it based on information and analysis that goes far deeper than what you're seeing on CNBC or reading in the mainstream financial press. Now, before we get into the specifics of what they're buying and why this matters for your portfolio, I need you to understand the context here. JP Morgan isn't just any bank. They manage trillions of dollars in assets. They have access to data streams that most investors can't even dream of. They have entire teams of analysts working around the clock, crunching numbers on everything from Federal Reserve policy to global supply chain dynamics to geopolitical risk factors. When an institution like this makes a major strategic shift, it's not based on a hunch or a gut feeling. It's based on a comprehensive analysis of where they believe the markets are headed over the next 6 to 12 months, and possibly beyond. For the past several months, JP Morgan's public messaging has been consistently cautious. Their strategists have been on financial news networks warning about recession risks, talking about the potential for further market downside, and advising clients to maintain defensive positions. Their research notes have highlighted concerns about corporate earnings, about the lag effects of monetary policy tightening, about stress in regional banking systems, and about the sustainability of consumer spending. All of this painted a picture of an institution that was positioned conservatively, expecting trouble ahead, and recommending that their clients do the same. But here's where it gets interesting. While that public messaging was going out, something different was happening behind the scenes. According to the leaked information that's now circulating among institutional circles, JP Morgan began quietly repositioning their own proprietary trading accounts and their internal investment strategies. We're not talking about small adjustments here. We're talking about significant capital allocation shifts that suggest they're preparing for a very different market environment than the one they've been warning about publicly. And this disconnect between public messaging and private action is exactly the kind of thing that sophisticated investors pay very close attention to. Because it often signals that the smart money is positioning for a turn in the market that has not become obvious to everyone else yet. So what exactly are they buying? This is where things get really fascinating because it's not just a simple story of going from bearish to bullish on stocks. The positioning appears to be much more nuanced and strategic than that. From what we're seeing in the leaked documentation, JP Morgan has been accumulating positions across multiple asset classes in a way that suggests they are preparing for a specific macro scenario to play out. They're not just buying everything indiscriminately. They're making very calculated bets on specific sectors, specific regions, and specific themes that they believe are going to outperform as market dynamics shift. In the equity space, the most significant accumulation appears to be happening in technology stocks, but not the high-flying, unprofitable growth names that got crushed over the past couple of years. Instead, they're focusing on established tech companies with strong cash flows, solid balance sheets, and business models that are either already profitable or have a clear path to profitability. This tells us something important about their thinking. They're not betting on a return to the wild speculation of the pandemic era. They're betting on quality companies in a sector that has been fundamentally oversold, where valuations have come down to levels that make sense even in a higher interest rate environment. This is a value play disguised as a tech play, And it's exactly the kind of contrarian positioning that makes sense when sentiment has gotten too negative. Beyond tech, there are also indications of significant accumulation in financial stocks, which might seem counterintuitive given all the concerns about regional bank stress and credit quality that have dominated headlines. But think about this from JP Morgan's perspective. They are a financial institution. They understand the banking business better than almost anyone. And if they're getting more bullish on financials after a period of extreme pessimism in the sector, that suggests they believe the worst of the banking concerns are behind us and that the sector is now pricing in too much bad news. Remember, some of the best times to buy are when fear is at its peak. And fear in the financial sector has been pretty extreme following the regional bank crisis earlier in the year. The currency positioning is equally revealing. According to the leaked information, JP Morgan has been building long positions in the US dollar after a period where many analysts were calling for dollar weakness. This is significant because currency markets are often the first place where big macro shifts become visible. If JP Morgan is positioning for dollar strength, that tells us they likely expect either a divergence in global monetary policy, where the Federal Reserve stays tighter for longer than other central banks, or they're expecting some kind of flight to safety scenario where investors seek the security of dollar-denominated assets. Either way, this positioning contradicts the popular narrative that has dominated currency markets for much of the past year, and it suggests that JP Morgan sees something different playing out. In commodities, the picture is more mixed but still instructive. There appears to be selective accumulation in industrial metals, particularly copper, which is often viewed as a barometer for global economic activity. If you're buying copper, you're essentially betting that industrial demand is going to hold up or accelerate, which contradicts a deep recession scenario. At the same time, there doesn't appear to be significant positioning in energy commodities, which suggests they're not expecting a major supply shock or a surge in inflation driven by energy prices. This selective approach in commodities reinforces the idea that JP Morgan is positioning for a specific scenario rather than just making a broad directional bet. Perhaps most intriguing is what we're seeing in emerging markets. The leaked documentation that suggests that JP Morgan has been quietly building positions in specific emerging market equities and bonds, focused particularly on Asian markets and select Latin American opportunities. This is fascinating because emerging markets have been largely ignored by most investors for the past couple of years, as rising U.S. interest rates and dollar strength made these markets relatively unattractive. But if JP Morgan is moving into these spaces now, it suggests they believe we're approaching an inflection point where the factors that have been headwinds for emerging markets are about to reverse. Maybe they're expecting the Fed to pause or pivot sooner than consensus expects. Maybe they're seeing leading indicators in emerging economies that suggest stronger growth ahead. Or maybe they're simply recognizing that these markets have been so thoroughly beaten down that the risk-reward has become compelling, even if the macro environment remains challenging. Now, let's talk about why this flip matters and what it tells us about the broader market environment. When large institutions like JP Morgan change their positioning, they're not doing it based on short-term market noise or temporary sentiment shifts. They're making strategic decisions based on their assessment of fundamental economic and market conditions over meaningful time horizons. The fact that they're willing to reverse a months-long bearish stance suggests that something in their analysis has fundamentally changed. Either new data has come in that contradicts their previous concerns, or market pricing has become so pessimistic that the risk-reward for being long has improved dramatically, even if their economic concerns haven't completely dissipated. One possibility is that JP Morgan's economists and strategists are seeing resilience in economic data that suggests recession fears have been overblown. Despite all the talk about inverted yield curves, despite the Fed's aggressive tightening campaign, despite concerns about consumer exhaustion, the U.S. economy has continued to show remarkable resilience. Job growth has remained solid, consumer spending has held up better than expected, and corporate earnings, while under pressure, haven't collapsed the way they typically do heading into a recession. It's possible that JP Morgan has concluded that the soft landing scenario that many dismissed as impossible is actually the most likely outcome, and they're positioning accordingly. Another possibility is that they're recognizing that market positioning has become so defensive that even modest positive surprises could trigger significant upside. When everyone is positioned for bad news, markets often rally on news that's just less bad than expected. If institutional investors are underweight equities, if hedge funds are heavily hedged or short, if retail investors have pulled money out of the market, then there's tremendous potential energy for a squeeze higher if sentiment shifts. JP Morgan might be getting ahead of that potential shift, positioning before it becomes obvious to everyone else. There's also the technical aspect to consider. Markets move in cycles, and we've been in a correction or bear market phase depending on how you measure it. At some point, cycles turn, and often they turn when sentiment is most negative and when the fundamental news still looks uncertain. The best market bottoms rarely occur when everything looks great. They occur when things look terrible, but the worst case scenarios start to get priced in. JP Morgan might be making the assessment that we're at or near that inflection point, where the market has priced in enough bad news that the path of least resistance is now higher. Now let's also consider the contrarian angle here. JP Morgan has been publicly bearish while apparently positioning more bullishly behind the scenes. This might seem deceptive, but it's actually a common pattern in how large institutions operate. They release research and public commentary that reflects their house view, but their actual positioning might be more nuanced or even contradictory to that public view. There are several reasons why this happens. Sometimes the public commentary is more conservative because they're speaking to a broad client base with different risk tolerances and time horizons. Sometimes there's a lag between when they identify an opportunity and when they communicate it publicly, because they want to establish positions before everyone else piles in. And sometimes, frankly, there's an element of strategic self-interest where being publicly cautious while privately accumulating allows them to buy at better prices. For individual investors watching this unfold, the question becomes, what should you do with this information? I'm not going to tell you to blindly follow what J.P. Morgan is doing, because your situation, your time horizon, and your risk tolerance are different from theirs. But I do think there are some important lessons and considerations that come out of analyzing their positioning. First, it's a reminder that market sentiment can shift quickly and that the consensus view is not always right. When everyone is positioned the same way, when everyone believes the same narrative, that's often when the market is most vulnerable to a reversal. Second, it highlights the importance of looking beyond the headlines and the surface-level narrative to understand what's actually happening beneath the market's surface. The disconnect between public messaging and private action is a signal worth paying attention to. Third, it reinforces the value of being selective and strategic rather than making broad directional bets. Notice that JP Morgan isn't just buying everything or going all in on a single theme. They're making calculated bets across different asset classes and sectors, building a diversified, long position that can benefit from multiple potential scenarios. This kind of nuanced positioning is harder to execute than simply buying an index fund, but it's also potentially more profitable if you get the calls right. Fourth, the emerging market positioning is a reminder that some of the best opportunities often exist in the places that everyone else has been ignoring. When capital flows out of a market or sector for an extended period, valuations can reach levels where the potential returns become very attractive, even if the risks remain elevated. So where does this leave us as we look ahead to the coming months? If JP Morgan's analysis is correct and they've timed this flip appropriately, we could be on the verge of a significant shift in market dynamics. The bearish positioning that has dominated institutional thinking could start to unwind. Money that's been sitting on the sidelines in cash and short-term treasuries could start flowing back into risk assets. Sentiment could shift from fear and pessimism to cautious optimism, and markets could rally even if the fundamental news remains mixed, simply because expectations have been set so low that modest positive surprises feel like major victories. However, it's also important to maintain some healthy skepticism here. JP Morgan is not infallible. Large institutions get calls wrong all the time. Just because they're flipping long doesn't mean they're right about where markets are headed. It's possible that they're early, that they're going to face more downside before their thesis plays out. It's possible that they're wrong about the economic trajectory and that recession risks are more serious than they're giving credit for. It's possible that some unforeseen shock hits the market and forces them to reverse course again. The point is not to treat their positioning as gospel, but rather to use it as one data point among many informing your own view of the market. What I find most compelling about this situation is not just the directional call that JP Morgan is making, but the methodology behind it. They're clearly doing deep fundamental analysis, looking at valuations relative to historical norms, analyzing economic data for inflection points, monitoring market positioning and sentiment for extremes, and then making strategic bets based on that comprehensive analysis. This is the kind of disciplined, research-driven approach that tends to work over time, even if individual calls don't always pan out perfectly. As individual investors, we can learn from this methodology, even if we don't have access to the same resources and data that JP Morgan has. The leaked information also reminds us of something important about market transparency and information flow. In an ideal world, everyone would have access to the same information at the same time, and markets would be perfectly efficient. But in reality, information flows unevenly. Large institutions often have informational advantages, not because they're doing anything illegal, but simply because they have more resources to devote to research and analysis. They have relationships that provide insights into what's happening in different sectors and regions. They have proprietary data sources that aren't available to the general public. When leaks like this occur, They provide a rare window into what the smart money is actually doing, as opposed to what they're saying publicly. That window is valuable, but it also needs to be interpreted carefully and combined with your own analysis and judgment. As we wrap up this deep dive into JP Morgan's positioning shift, I want to leave you with some final thoughts on how to think about this information practically. If you're already invested in the market and you've been worried about your positions, given all the bearish headlines, this might provide some reassurance that maybe the worst case scenarios are less likely than you feared. If you've been sitting on cash, waiting for a better entry point, this might be a signal that waiting much longer could mean missing the turn. If you've been heavily short or defensive, this might be a prompt to reconsider whether that positioning still makes sense given where we are in the cycle. And if you've been ignoring markets altogether, this might be a wake-up call that interesting things are happening and that opportunities might be developing that are worth paying attention to. The broader lesson here is about staying alert and adaptive in your investment approach. Markets are constantly evolving, and what made sense 6 months ago might not make sense today. The institutions that succeed over the long term are the ones that are willing to change their views when the evidence changes, even if that means admitting they were wrong or reversing positions they've held for a while. JP Morgan flipping long after being publicly bearish is an example of that kind of adaptive thinking. And whether their call turns out to be right or wrong, the willingness to adjust is itself a valuable trait that all investors should cultivate.